What if I told you the silver market isn't actually a market at all? It's a casino where the house changes the rules the second you start winning. Let me show you something that'll make you rethink every chart you've ever looked at. Early 2026. Silver's been climbing. Not crazy, just steady. It breaks through $32, pushes toward 35. Retail investors are excited. The technical analysts are calling breakouts. And then, overnight, the CME group, the people who run the COMEX exchange, decide to raise margin requirements from 11% to 18%. Sounds boring, right? Just risk management. That's what they'll tell you. But here's what actually happens. If you're holding a standard silver futures contract, that's 5,000 ounces, your position is worth about $150,000 at $30 per ounce. At 11% margin, you need $16,500 in your account to hold that position. Totally manageable for most funds and speculators who use leverage. Now the margin jumps to 18%. Suddenly, you need $27,000. That's an extra $10,500 per contract. And if you're running 100 contracts, you need an additional $1.05 million in your account within 24 hours. Or your broker liquidates your position automatically. No negotiation. So what happens? Forced selling. Massive forced selling. Silver drops 12% to 15% in a matter of days. The headlines call it profit-taking or a correction. But nobody's taking profits. They're being thrown out of their positions by a rule change. And here's where it gets weird. While paper silver, the futures contracts traded on COMEX, is collapsing, physical silver prices at your local coin dealer barely move. In fact, premiums go up. American Silver Eagles are trading 20% to 35% above the spot price. You can't buy an ounce of physical metal anywhere near the crashed COMEX price. I spent days going through CME margin data, CFTC reports, and dealer inventories trying to understand this gap. And what I found is a pattern that's been repeating for over 40 years. Let's go back. 1980, Silver Thursday. The Hunt brothers tried to corner the silver market. They bought so much silver that prices hit $49.45 an ounce. The COMEX panicked. They didn't just raise margins. They changed the rules to liquidation only. You could sell, but you couldn't buy. Silver crashed to under $11. The Hunt brothers lost everything. Was that about protecting the market or protecting the people on the other side of that trade? Fast forward to 2011. Silver's rallying toward its all-time high of $50. Between April 26th and May 5th, the CME raises margins 5 times in 8 days. 5 times. Silver drops 30% in a week. Then 2021. The Reddit crowd tries to organize a silver squeeze. Same playbook. CME raises maintenance margins by 18%. And now, 2024 into 2025. Silver breaks resistance at $32. The CME implements tiered margin increases, citing extraordinary volatility. Do you see the pattern? Every time silver starts to run, the margin hammer comes down. Every single time. But let's steelman the other side for a second, because I'm not here to just confirm your biases. The CME will tell you this is prudent risk management. They'll point to their value at risk models. They'll say volatility spiked, and if they didn't raise margins, a major player could default, and the clearinghouse would be on the hook. They'll reference the LME nickel crisis in 2022, where the exchange had to halt trading because positions went so underwater that the entire system nearly collapsed. Fair point. The CME isn't a charity. They're a clearinghouse. If someone defaults, they eat the loss. So raising margins when things get crazy makes sense, right? Margins go up fast, but they come down slow. I pulled the historical margin data. When silver rallies, margins spike within days. When silver crashes and stays low for months, Margins might eventually come down, but it takes weeks or sometimes doesn't happen at all until the next cycle starts. That asymmetry matters because it means the system is structurally biased towards suppressing upside moves, but doesn't provide the same relief on the downside. There's also the question of who holds the short positions. The CFTC releases something called the Bank Participation Report. It shows which banks are holding futures positions. And what you find is that 4 to 8 banks consistently hold a massive share of the short side in silver. We're talking concentrated positions that would be illegal in equities markets under anti-manipulation rules. When margins spike and long positions get liquidated, these shorts get to cover at lower prices. It's a bailout mechanism dressed up as risk management. Think about that for a second. The same banks that were too big to fail in 2008 are holding enormous short positions in silver. And every time the market moves against them, the exchange steps in with a margin hike that forces their counterparties to sell. Coincidence? Maybe, but it's happened too many times to ignore. Now let's talk about the mechanics, because this is where it gets technical, but it's worth understanding. When the CME raises the initial margin, they also raise something called the maintenance margin. That's the minimum amount you need to keep a position open. If your account equity drops below that level, you get a variation margin call. Your broker liquidates your position immediately. But it doesn't stop there. Because when big funds start selling to meet margin calls, they trigger stop-loss orders sitting just below key technical levels. Maybe it's the 50-day moving average. Maybe it's a Fibonacci retracement. Doesn't matter. Those stops get hit, which creates more selling, which triggers more margin calls. It's a feedback loop, a liquidation cascade. And it's not driven by fundamentals. It's driven by market architecture. Meanwhile, physical dealers are watching this happen, and they're scratching their heads. Because they know they can't replace their inventory at these crashed prices. Wholesalers are sold out or charging premiums that reflect the real supply situation. So the dealer keeps retail prices high. This is the decoupling. Paper price says $28. Physical price says $35. The market is broken into two markets that don't communicate. And here's the kicker. Most of the contracts on COMEX never result in physical delivery. Less than 5% of contracts end with someone actually taking possession of metal. It's a paper game. The COMEX is dictating the price of a physical commodity it doesn't actually hold in full. I went through Bullion Star's analysis on this. They track physical premiums globally. And what they found is that during every major COMEX margin-induced sell-off, physical premiums either stay flat or rise. Singapore, Hong Kong, Zurich. Doesn't matter. The physical market ignores the paper crash. So who's right? The futures traders or the physical buyers? If you're a retail investor holding physical silver, you watch your net worth drop on paper because spot price is tied to COMEX. But you still have the same number of ounces. And if you try to sell those ounces, you're not getting the crashed COMEX price. You're getting something much closer to what you paid. It's a psychological trick. The system makes you feel poorer without actually changing the physical reality. Now let's talk about incentives. Because markets are just people acting on incentives. The CME group wants to avoid systemic default. If a clearing member goes bust, the exchange is liable. So they're incentivized to raise margins aggressively. The bullion banks holding short positions want lower prices. They profit when silver drops. Margin hikes help them cover shorts or reduce exposure. Hedge funds and speculators use leverage to amplify returns. They're the ones getting blown out by margin hikes. Their business model relies on cheap borrowed capital. When that capital gets more expensive overnight, they're finished. Retail physical holders, they're not even playing the same game. They're buying for long-term wealth preservation. They suffer paper losses, but they're not forced sellers. The system is designed to extract wealth from the leveraged speculators and protect the shorts. That's not a conspiracy. That's just how the incentives line up. Here's what I can't figure out though. If this pattern is so obvious, why does it keep working? Why do speculators keep piling into leveraged long positions, knowing the margin hammer could drop at any moment? Maybe it's greed, maybe it's hubris, or maybe it's just the nature of leverage. You win big until you don't. But there's a bigger question here. If the paper market can be manipulated, or at least heavily influenced by margin policy, what does that mean for price discovery? Is the spot price of silver actually reflecting supply and demand, or is it reflecting the risk tolerance of the CME clearinghouse? I don't have a clean answer to that, but I know this. When paper and physical diverge this consistently, something's broken. So what happens next? If history repeats, silver will consolidate at these lower levels. The leverage longs are gone, open interest will drop, and eventually the physical market will reassert itself. Maybe it takes months, maybe longer, but the next time silver starts to rally, and it will, watch the CME, watch the margin requirements. Because if they hike again at the exact moment silver breaks resistance, you'll know this wasn't about risk management. You'll know the game is rigged. And the real question isn't whether you believe that. The real question is, what are you going to do about it?